All right, steady quarter for Union Bank. Return on assets improving, asset quality improving. Ankur caught up with the managing director.
Actually, we believed upon the efficiency, and always I say from the board level to down below, we are emphasizing on 5 pillars. So efficiency is one of them, how to build the efficiencies across organization, whether it is an operational or whether it is a fund management or anywhere. The second is the robustness in the organization, because unless you are compliant, you are disciplined, and you are assured, like assurance function is too good, so you will not be in a position to build the business. And the third is the sustainable, profitable business. And the fifth is the quality of the profit you are bringing into from the core operations. And the last one is the customer centricity, staff centricity, ease of doing business. So all these 5 things. So I think since December, you must be seeing that the profit is hovering 5,000 plus, and we are trying to build from there. And not only profit, I would also say that other than profit, like the last quarter we have kept 700 crores separately for strengthening the balance sheet, which is certainly not part of a profit, but also not part of a PCR. So, and this quarter again 100 crore we have kept it, so total is 800 crore. So I think the major is efficiency, and the efficiency, if I would like to say, certainly our CD ratio, loan to deposit ratio was 74 around earlier, and now it has moved to 84, 85, 86%. That is one. Second is the dip in the 18 bips in the cost of deposits. So I think that has also supported us very well, and there itself we got. And the thing is that IBPC we shed off 33,000, and then there were lower yielding some portfolios where it was less than 6 or maybe less than 6.15 or 6.30, so which we have shed. I think all these measures and contributed. And when we take about RAM sector and the corporate book, so we are very much conscious of underwriting a business which is of quality and profitable. So that is the reason last 3 quarters you will see that our CIC score, which is in RAM retail sector generally, RAM sector, retail sector. So there you will see that our 700 plus is maintained, that 99% ratio. And second is about 25 crore portfolio, which is externally rated. That is also maintained. So we are very cautious on writing a quality book, but then we need a profitable. So I think all these things put together has helped in the building, and certainly the TWO recovery which we have done from year 2. And most importantly, your slippages should be lesser than, recovery should be more than slippages.
So that formula has been maintained. I want to also ask you about the deposits part, where a kind of muted growth is there. What is your strategy there for the rest of the year?
See, the thing is that let us take the source of funds. So one is your capital, and then after the capital you can say even tier 1, tier 2 bonds, or maybe infrastructure bond or MTN, and maybe various instruments are there for that. And then it comes the total deposit. First is the bulk deposit, second is the retail term deposit, and the SA and CASA. Right. And it is not like we are not doing deposit. So the first is that we had capital with us, more than 18%, and CD ratio was quite lagging. And for 1% point, it comes to 8,000 to 10,000 approximately. I am saying it will depend upon the bank to bank organization. So then 1 lakh crore I could get the credit growth from here itself. The question is that if I am having with my own money, so why to? Another thing is that whether my liquidity position, which is LCR and NSFR, both are comfortable. So I think average is 121, above 121 average. So I think that gives a very good, because RBI itself is 100% and our board approved is 107. So we are, even our board approved, we are more than 14%. And NSFR. So I think keeping in this view, up till now, as I said, we worked upon efficiency. We totally worked upon how to increase the return on loan book and how to reduce the cost on deposits. This was the main part of the entire efficiency which we have tried to build, and we are a bit successful. That is why there is an increase in the NIM from 2.64 to 2.80 levels. So yes, going forward, again, FCNR has come, and we aspire to be 1.5 to 2 billion, so around 20,000 crore. So that is going to come. That is what we are aspire to achieving, and we will be achieving it. Because up till now we have done 106 million without any leveraging. So we have pipeline and we have customer already we have discussed, so absolutely that is not an issue. So going forward, because the efficiency, there is a level.
Right.
So certainly when we talk about the credit growth of the industry level plus something better than that on both RAM and corporate book. So deposit will follow, obviously. So the question is basically more challenging, I would say, is the retail term deposit and CASA rather than bulk. Bulk is a total factor of your rate. So if you give, even today, if you want 7.3, 7.4 levels, you take 1,000 crore or maybe 5,000 crore. So that is available. So that is, but then it has a cost. And then again your efficiency is totally impacted. So the thing is that till your entire ecosystem in banking, because if one thing you increase, it impacts other thing in the banking balance sheet and P&L. So if that everything is in order, first is try your CASA, RTD, and maybe if the market supports infrastructure on a rate of interest basis or an MTN or any other, that is, or else better bulk deposit. So we are in line with that, absolutely. And also I would like to give you one color that even this quarter we have taken 40,000 crore because the corporate generally institutions, big institutions, we have not seen last 3-4 years they are putting money more than 1 year. Hardly 5% people will put for 1.5 or 2 or 3 or 4 year. So there is a churning across the year. And this quarter also again it is around 60,000. So we have to do it. So absolutely that is not an issue. And we are doing it. But the thing is that being cost cautious, how to take better benefits opportunity available and then going forward.
Right. And what is your guidance for credit and deposit growth this year?
I think that the industry which is growing, we would like to grow in the same fashion, better than that, because if we want to build further efficiencies, it has to be built on that, on the credit side. Deposit side, as I said, we will be following because maintaining all the robustness in the balance sheet, maintaining all the liquidity ratios, all the compliant bank, because our the first principle in the bank, if even you see the presentation, is the business first, compliance always. So the question is that we want to be compliant every time. So with that, whatsoever is required, that any day you can take. So that is not an issue. So we will follow, I think, going forward, I believe that 8 to 9% deposit growth is going to come. So as we move forward.
But credit growth will continue.
All right, that's one corporate conversation. Let's switch over to the next one. We have Gopal Balachandran, Chief Financial Officer at ICICI Lombard, joining us. Mr. Balachandran, great having you. Let me start off with trying to understand the combined ratio. It's deteriorated meaningfully this quarter. Beyond the one-off impact of the Supreme Court provision and the 2 large fire claims, what were the key underlying factors that put pressure on underwriting margins?
From an ICICI Lombard standpoint, I think the thought process of continuing to write profitable growth and therefore appropriate risk selection as a philosophy is something that continues to remain intact. There is absolute no change in the thought process of how we want to kind of look at writing risks, even historically and even for the way forward. And therefore, when you put that in context, I think what we are seeing insofar as the business momentum is concerned, I think we are seeing a very, very positive trend overall insofar as the economic activities and therefore the impact on ground. And to that extent, that significantly augurs positive both for the industry and more importantly for ICICI Lombard in general. And that's how the quarter is also kind of largely reflective of. I think when you look at the core or let's say the base business model, I think that pretty much remains intact. Exactly to your point on some of the events that have kind of obviously come in this quarter, I think rightly mentioned on both the judgment of the Honorable Supreme Court of India, and of course, we did have a couple of large losses in the fire segment. And that's the reason why we specifically put both of them in terms of the impact that it had on the combined ratios. On the judgment alone, I think at this point of time, this is the prudent and conservative estimate that we have put across. That had an impact on the combined of roughly about 2.8%. And the impact of the two large losses on the combined was roughly at about 1%. And when you kind of take this out, and as we keep saying that you have to keep looking at combined on an N basis, the combined ratios is pretty much in line with what we have been speaking even in the past, as in to say that quarter one of last year was at a combined of 102.2%, excluding a couple of these events, which also has kind of industry impacting elements. For us, the combined would have been 102.3%. So in that sense, I think a very, very satisfying quarter. I think when we look at it on an overall basis, I think of course these are some of the events that have happened during the period.
Right. And is the 165 crore rupee reserve strengthening sufficient based on current estimates, or could there be further reserve additions as claims experience evolves?
So again, a good question to ask. I think just to reiterate, I think this is a judgment that came in the month of June, and so hence to that extent, I think it's a recent one, and that's the reason one kind of called out to say that what we have done at this point of time is we have tried to see what is it that could preliminarily have an impact insofar as the overall industry loss ratio outcomes are concerned. So that's one. And secondly, therefore, when you look at it from an ICICI Lombard standpoint, I think the judgments of the courts on the third party portfolio is something that is inherent as a part of the business that we do. And this is not the first time that we have seen judgments coming and impacting the book. Even historically, at several points of time, way back in, for example, 2008, we had a judgment. We had a judgment in 2017. We had a couple of judgments in the financial year 2021. So even at each of those points, and more specifically since the time we got listed post 2017, in 2021, when a similar kind of a judgment had come through, following an approach of prudence and conservatism in our claim reserving thought process, I think we have continued to follow the same. The fact that there's a judgment that came in Q1, it was rightful for on our part to kind of do an assessment and see what does it do insofar as the need for any claim reserving. Considering a holistic assessment of the past book as well as the book that we have till 30th of June, as I said, we have again put a prudent and a conservative estimate. And on that basis, I think the reserve addition that we have kind of taken is about 165 crores. So hence, we will obviously see, as I said, there's a lot of factors that are variable. How each of them play out is something that will determine the adequacy or inadequacy of it. Having said that, when you see the reserving triangle disclosures, which is now a public information for pretty much every player in the market, whether they are listed or otherwise, ICICI Lombard on its motor third-party portfolio has been consistently depicting a small amount of reserve releases. So that clearly speaks of the adequacy and the strength of reserves that we have. And hence, to that extent, I think, as I said, we have been absolutely prudent and conservative in the estimates of 165 crores.
Gopal, can you also provide some color on the two large fires which led to increase in combined ratio? Were these isolated incidents, or do they reflect increasing risk within the commercial property portfolio?
The only reason for us to call out is for us, I think, as we keep saying, we are in the business of risk. And therefore, to that extent, losses are pretty much a part and parcel of the process in terms of what we do. Having said that, if there are any risk events which has a relatively higher proportion in terms of its possible impact on a given period, then to that extent is the only reason why we have called it out separately. So hence, both of these large losses on the fire portfolio has had an impact, as I said, on the combined ratios by about 1%. And inherently, and that is also, which was one of the questions that one had asked, if one were to have excluded these two large losses, what would have been the outcome of the fire loss ratios, which currently is at almost about 118%. If you go back to history, ICICI Lombard has never delivered a combined ratio on fire at such a magnitude. When you look at long-term averages, our fire portfolio loss ratio has generally ranged between 65 to 70%, has been very, very profitable. And therefore, to that extent, insofar as that's the reason why I said on the thought process of risk selection, I don't think there is any fundamental challenges. I think that's the nature of the business that we are in. And therefore, to that extent, these two events happened in this quarter. And hence, we have kind of called it out separately. But otherwise, no fundamental challenges in the way we are kind of underwriting that segment. And the good news is, I think the relative competitive intensity that we had seen on April 1 being the largest time cycle for renewal of fire policies. When you look at in the month of June, the extent of degrowth that the industry has experienced has kind of seen a come off. So that's very, very positive. And even for ICICI Lombard in that context, when you see the month of June, I think we have been better than the market.
Okay, and fire insurance pricing has remained competitive, is what you suggested on the con call. Are you seeing early signs of pricing discipline returning? Does competitive intensity continue to weigh? How should one look at margins? Give us a sense.
Again, let me put this in context, which is what I kind of talked about. I think our thought process of writing any risk, whether it is retail lines or whether it is commercial lines, I think the philosophy remains the same. I think, and more importantly, on the commercial lines, there is an additional stakeholder to whom we are equally accountable for, which are the reinsurers. They are equally providers of capital because these are relatively large exposures. And therefore, we do tend to kind of reinsure a portion of the risk that we underwrite. So therefore, there's an added responsibility on us as primary insurers of the risk. And in that context, when you look at ICICI Lombard over years, particularly on the commercial lines and more importantly, the fire segment of business, what we have been able to exhibit as an outcome has been a very, very profitable outcome insofar as writing that segment is concerned. And that's the reason why time and again, in most of our earnings call, we keep coming back and saying that the terms that we have been able to get from our insurers have been a very, very positive one. So hence, to that extent, absolutely, absolute sense of discipline is what we kind of exhibit, particularly to writing some of these large exposures. And that's the reason why we have seen an outcome which has been favorable for ICICI Lombard. Specifically in the context of how the market is kind of responding to, and that's the reason why I called out. If you look at Q1, the industry degrowth for fire was roughly about 27%, against which ICICI Lombard's degrowth was almost about 32%. But when you look at the month of June, ICICI Lombard, the industry degrowth has kind of slightly come off. It is now at about 22% as against 27% for Q1. And for us, against the 32% degrowth that we had a degrowth of about 18%. So it is actually better than the market for the month of June. And therefore, the momentum on ground, I think, is looking very, very positive. And that's exactly opportunities which we look forward to underwrite from an ICICI Lombard standpoint.
Right. And following these losses, are you making any changes to underwriting standards, risk selection in the fire portfolio?
I think, again, before I answer specific on that, I think particularly on the fire portfolios, what we have been exhibiting is a lot of value-added services initiative insofar as working with corporates are concerned. Because fundamentally, our business is, there are two ways to look at what we do. One is we can be simply be a transferer of risk of a corporate, as in corporate can place their insurances with us, which is nothing but a risk transfer practice. The second is, can we do a lot more value add for a corporate to try and see if that corporate can possibly take steps, initiatives to possibly try and minimize instances of risk events. So on value-added services, that's an initiative that we instituted way back in 2014. And we work with a lot of corporates to kind of work with them and see how, in the event there have been loss events or risk events, how over the longer term they can possibly make various interventions and in the process possibly try and minimize some of these losses or some of these risk events. So that's exactly what we will work with the commercial corporates in general. And we have clearly seen huge positives play out in terms of the experience that we have seen subsequent to the value-added services initiative. And more importantly, given that we are also doing this particular service, the extent of customer retention in terms of the number of corporates who tend to kind of stay on with ICICI Lombard is a very high number. So it helps us on the dual front, and that is exactly what we will continue to exhibit even when we look at in the current context.
Right. Great to have you on the show. Thank you so much for your time then. That's the word coming in from the ICICI Lombard management on their earnings. Stocks still lower by good 11% as we speak. We'll take a very quick break on that note. When we come back, we'll get you the F&O picture in the markets.
Welcome back and thanks for being with us. We're joined by Girija Shankar Ray, a research analyst at Nirmal Bang, to talk to us a little bit about what's playing out in the cement space, to try and understand that landscape better, because we've seen, some stocks start to move, and the kind of commentary that Nuvoco gave as well seems to have enthused the street a little bit. Girija, let me start with Nuvoco and what that indicates from a sector standpoint. How do you look at the numbers and what do you make of the commentary?
See, the numbers were actually, very good, even though top line was, in line with the street estimate. But if you talk about their EBITDA, uh, it beat the market estimate. It's like street was, it's around 16% higher than your street estimate, I can say. So they have delivered a very strong EBITDA for this quarter. See, the thing is that is mainly because of their higher realizations. In fact, volume also supported. So over the years, if you talk about the Nuvoco's volume growth or utilization rate, significantly it has improved. And recently they have commissioned their 2.2 million ton of capacity, which was about to start in quarter 3 FY27 and 1Q FY28. So the expansion they have started a bit earlier than the time frame. So that is a positive thing, and I believe this newly commissioned capacity that is going to give the volume addition to the overall volume picture. So you can expect a volume of around 24 million tons by FY28, 22 million tons by FY27. So Nuvoco, I believe the volume realizations and the strong cost efficiency that is going to improve their overall profitability.
And what does this indicate? All of this, what does it indicate from a cement standpoint or an industry standpoint? Also a geography standpoint. Give us a sense of that, because cement is very much a geographic kind of business, especially from a realizations perspective.
Yes. See, I'll cover three things. One is demand, one is second one will be your pricing, and third one will be your cost efficiency level. Okay. So demand, what I believe, you have a pent up demand in your, FY25 and 26. In fact, if you talk about FY25, the year on year demand was around 2.5% or 3%. So there is a pent up demand in FY25, and in fact, FY26 we saw a little bit, subdued in volume. So these pent up demand is going to come by second half of FY27, and FY28 will be very good for the cement industry, because post that again election will be, in FY29 you can expect this pre-general election. So I can expect some kind of pre-general election kind of demand boom from FY28 onwards. So very much of demand you can see in FY28. But FY27, second half of FY27, you will see demand pickup in the industry. That is first thing about the demand. Coming back to the pricing, see what happened from we did a channel check, and what we found for over first quarter of FY27, only 15 rupees kind of price hike has happened. That is into April month. May and June there was no price hike at all. So if you compare first quarter and fourth quarter, fourth quarter of FY26 and first quarter of FY27, there is a price hike of around 4% a quarter on quarter basis. So that translates into 15 rupees per bag. But highest price hike was happened in your eastern regions, followed by north region, south, central, south, and west. So this is how it does. So overall, you can say highest price hike was happened in your eastern region. So the regional players will be having the very good benefit because of this price hike in first quarter FY27. So, but I do not see any meaningful or any significant price hike because there are a lot of competition in the market and large players are actually dominating, and most of the large players are trying to sell a lot of volumes in the market. So there will be a kind of a pressure will be there from the large players, which will ultimately will not take the price to that level what street is expecting. But to be honest, I'll tell you, the price at this moment, the price is in a threshold. From here there is no point of correcting this price, and I don't think so there will be any correction from this price. If there is any price hike, it will be marginal price hike, but I cannot see any kind of significant price hike like 40 rupees, 50 rupees per bag. Although there is a cost, elevated fuel cost, power and fuel cost, like recently because of geopolitical issues, your petcoke petcoke price has increased, diesel price has also increased, packaging cost has increased. So altogether, all these cost has increased. To absorb that cost, the price hike has taken. But again, I'll tell you, the all India price hike of this 15 rupees is not sufficient enough to absorb the full cost impact. So again, one more point I want to add it here. So there always we have seen the industry, there was a pre-monsoon price hike, but this time there is no pre-monsoon price hike. So whichever the price hike is going to happen, I believe that will be post your kind of second half of the year FY27.
Yeah. What is the kind of realization gains that could come in Q1 and maybe Q2, given the fact that you just said that the cost increases would have been offset by the price increase, and there hasn't been one price increase before the pre-monsoon. What kind of realizations are we looking at for many of the companies, whether it's Ambuja, Ultratech, or Nuvoco?
See, based on this price hike, the realization will be good. I can say the realization will be good, but at the end, the cost, higher cost. So this is going to impact the EBITDA per ton. So overall, for the industry, we are we see a EBITDA per ton of 1,000 kind of level
For
in one Q FY27.
yeah, for Ambuja and Nuvoco, I mean, is it going to be a better EBITDA per ton realizations coming in this quarter?
See, our topics are like Ambuja, then Villa Cup, Nuvoco, and JK Lakshmi. So we believe these other companies are going to do well, despite having this elevated cost and the kind of volume pressures also in the industry. See, generally what happened, fourth quarter is always a volume-driven quarter, and first quarter is always a price-driven quarter. So this price hike is just mainly to absorb the full cost impact of the elevated energy cost, packaging cost, and diesel prices. So that is what I'm saying. Like this quarter you will see a little bit of subdued in volume. But yes, the quarterly first quarter FY27 volume will be relatively better than your first quarter FY26 volume.
Girija, thank you very much for joining us and giving us this perspective on the cement situation, especially from a price and volume point of view in Q1. Thank you very much.
Thank you.
Well, moving to the futures and options market, the Nifty is hovering about the 24,100 mark at this point in time. If you look at the bank, IT index is up nearly 1.5%, and Nifty Bank is down nearly 1.14% there. But as I said, Nifty is up just 0.21%, and there's a decline in open interest. So we're seeing some shorts getting covered in today's market for the Nifty 50 at least. Nifty Bank, again, there's decline in the index there. The open interests are up. There is some shorts getting built up. Look at the Nifty Bank constituent, and it gives you an indication of what's happening in that pack. short build-up happening in HDFC, ICICI, Axis, PNB, SBI seeing some long build-up. And there's short covering which is happening for Bank of Baroda as we speak there. But to look at put and call ratio writing, there's a excessive call writing at this point in time. If you look at the market as a whole, you have 24,100 where we have seen put writers have taking up positions there. The call and put writers are active in 24,200 as well. Look at the distribution chart and you will see that you have a resistance coming at 24,200 with call open interest higher than the put. And there is some build up happening at 24,100. So watch out for the second half. Are you going to see some kind of volatility in the market with the Sensex expiry also expected today? So that's one thing. Futures gainers include SRF up 4.7%, Dixon is up 4%, and Swiggy is up 4%. All of them seeing a long build up, and Swiggy seeing a short covering there. In the losers pack, you have ICICI Lombard down 10.8% back a weak set of numbers. Especially the Q1. HDFC AMC is down 4% and PB Fintech is down 3.6%. All things short build up happening there. Open interest gainers include stocks like ICICI Lombard, which is seeing a 23% jump in open interest, and Dixon is seeing a nearly 9.3% jump, and Patanjali Foods is the stock is up. The open interest seeing up by nearly 6% in Patanjali Foods there. But the most active one in the losers pack, you have Swiggy seeing a short covering, Kalyan Jewellers is seeing a long unwind, and Exide is seeing a short covering. But in the most active stock options, Dixon 15,000 July call up 1.13 lakh contracts after the ISM 2.0 been announced by the government. The premium up sharply by 114 to 186, and the stock hovering at 14,246 level there. The other one is ICICI Lombard 1600 July put. The stock trying to hold off at the 1600 level, currently at 1618. The premium up 30 to 33.9. To see the sharp jump, premium jump, which volatility which we are seeing in the premium of Lombard, the open interest up nearly 4 lakh contracts, so mostly short positions getting added in the put strike of 1600 for ICICI Lombard. So the market holding off to 24,100 levels. So you're going to see some volatility coming in given what we are seeing in the options market, but that's what we have as of now. Right?
Yep, completely timed out on this edition of First Trades from Sajid, Aisha, myself, everyone who puts this show together. Thanks so much for watching. Stay tuned to ET Now. More action to follow.
Hi there, good morning. You're watching Midcap Masala on ET Now. I am Snehi Shah. With me is Meryl D'Souza, and you're catching us live from the Suzlon studio here at ET Now. This is the show where we're going to be delving deeper into the broader end of the market, give you a better sense of what's happening at the index level and also some stock-specific action. And of course, we've lined up some great conversations for you with managements from the broader end of the market. Before we get to that, just taking a look at what's happening at the index level, 0.2% uptick coming in on the Nifty. Yes, but we're absolutely flat when it comes to the Nifty mid-cap as well as small-cap indexes. Very flat moves coming in over there. At a stock-specific level, let's start by talking about Mrs. Bector's Food. A good move coming in on that stock, 11 to 12% higher over there. Sunil Singhania's Abacus Investment Managers has acquired a 1% stake in the company at Wednesday's closing price of 168.97 rupees per share. They've picked up 29.3 lakh shares in the company, and good moves is something that we're seeing on the stock right now, 13.5% higher.
That's right, but also buzzing in trade today is after the Union Cabinet approved the mobile phone manufacturing scheme along with a 62,500 crore outlay. This scheme is to strengthen the electronic manufacturing ecosystem in India and is also going to be promoting domestic production, with Dixon Tech emerging as a major beneficiary. We've also seen multiple brokerages, the likes of HSBC and Macquarie, upgrade the ratings on the stock on the back of this news as well.
Okay, looking good for Dixon as well. 4.25% uptick on that front. Himadri Specialty Chemical is in focus. Strong earnings for Q1. That's something that the company has reported, and record quarterly revenue with EBITDA and PAT also reaching their quarterly records. And profit has risen 26% with a revenue growth of 28% on a year-on-year basis. So looking good for Himadri Chemicals. That stock is up 4% as we speak.
That's right. MV Photovoltaic also in focus on the back of a tremendous set of numbers that the company has put out for the first quarter. PAT for the company has more than doubled on a year-on-year basis, surging up to almost 102%, reaching 380 crores, which was supported by expanding operating margins for the company. Operating margins stood up to around 35.2% on a year-on-year basis. Revenue as well was up almost 51% for the company on a year-on-year basis as well. That as well is performing really well in today's trade, almost up more than 9% so far as we speak right now.
Okay, so that's on MV Photovoltaic, looking good on that one. Let's talk about the next stock, and that's Unimech Aerospace. That's in focus on the back of an initiation coming in from the house of Motilal Oswal. Motilal Oswal initiated coverage on the stock with a buy rating and a target price of 1530 rupees per share, citing competitive pricing, new engine programs and favorable industry tailwinds. Motilal also expects strong earnings growth over FY26 to FY28, supported by margin expansion and inorganic growth opportunities.
MRPL has also reported a strong set of first quarter numbers. Their performance has been tremendous as well. PAT has rebounded to 946 crores after facing a loss a year ago, and the company has also seen an improvement in their EBITDA margins sharply on the back of stronger refining performance. That stock as well is doing pretty well in trade today, up 12.5% as we speak.
Okay, so that's a roundup of all the stocks that have been buzzing from the broader end, some of the biggest buzzers over there. Let's shift focus and shift the conversation to one of the earnings candidates. Good set of numbers coming in from MV Photovoltaic. The revenue has come in at 1,556 crore rupees in Q1, a very healthy uptick of 51% on a year-on-year basis. EBITDA is up 57%. When it comes to the net profit, it's been a doubler on a year-on-year basis at 380 crores. Remember, this time last year, that number was at 188 crore rupees. So good jump coming in over there, and healthy moves coming in on the margin front too, at 35.2% compared to 34% this time last year. Let's understand what has led to such a good move on an MV Photovoltaic in terms of their earnings, and what's the outlook going ahead. More importantly, we've got DV Manjunatha, the founder and MD at MV Group, joining us on the show. Mr. Manjunath, hi, morning, and thanks for your time. Let's start by speaking about how this quarter has shaped up for you. You know, so much is happening in the sector that you operate in. There is also a lot of government support trickling in. Talk to us about some of the levers that have led to this kind of growth for you, and going ahead, do you believe that this 35% margin number is sustainable?
Thank you for having me to the ET now. As you rightly said, definitely the policy has also favored well, and the numbers what we have given to the first quarter is in line with what we have projected. If you see the earlier conversation what we had with you, and the going forward, I instead of I say an absolute percentage, I will stick to the absolute number, which we already said earlier also, and we are in line with that, about 22,100,000 to 24,000 crores. This is the EBITDA level what we are looking into this financial year.
Right. Good morning, Mr. Manjunath. Meryl D'Souza here, also joining in on this conversation. I'm seeing effective solar cell capacity utilization has hit a record 83% in the first quarter of FY27. And you had previously guided for a phased transition from M10 to the G12R cells by the end of the first quarter. Could you share along with us an update on the progress of this, and what benefits do you expect this transition to bring going forward for your company?
So as we initially also said that we can able to reach the cell utilization up to 90%, we can able to reach. So we are in that line, and we have reached 83% in that M10R category. But as we already communicated, and you also said that G12R we have moved in the last month, that is in the month of June. So this will give us more utilization factor in the coming days or coming months. Reason is the pattern of that cell is going to be, as presently we are about 8.5 watt of the per cell what we are producing. Now it's going to be 9.5. So that factor itself is going to be increased to the extent of the utilization, and also throughput going to be increased. And this will
Understood.
definitely, as this is the new technologies, and which is going to be need for the C&I and IPP, which is going to be made mandatory by the government of India from 1st June 2026.
Okay, understood. Mr. Manjunath, let's talk about your order book. That sits at an all-time high of 9.9 gigawatt right now after securing 1.48 gigawatt of inflows during the quarter gone by. Help us understand a couple of things over here. First, what is the execution timeline for this 9.9 gigawatt order book? What is the timeline for conversion to revenue? How much of this will trickle in into revenue in FY27 versus how much of it will spill over into FY28?
So around in the order book of 9.9 gigawatt, at least 50% will going to be executed in this financial year. Remaining 50% is going to be comes into the financial FY28. Apart from that, as you see that month on quarter, we are increasing our order inflows. That will take care of our numbers what we need to achieve in this financial year.
Right, understood. Sir, one more thing. Last quarter, you had noted an inventory buildup which was necessary for the run rate of the operations, and you'd also mentioned it being mindful of converting this going forward. So, can you just give us a quick update on how has the situation evolved in this quarter gone by, particularly with respect to cash flow in addition to the inventory levels as well?
The inventory level are in the same level now, and it is going to be, as we said earlier also, it is going to be better off in the coming quarters. And also you can see our top line also will going to be increase on quarter. The first quarter always going to be less quarter compared to the second, third and fourth quarter. That is how the standard our industry which will run, and that will definitely take care of inventory in a better position. And the cash flows, we are in a better position as our business models is earlier also I said very clearly, we do with either before before delivery the cash, or the LC backed with LCs. That will vary sometimes, because some of the customers will opt for the 60 days, 90 days or 30 days of the LC usage period. That cost will be included in the price, that interest cost. So that will have the cycle of the cash flows. But cash flows, you see also this quarter, it is healthy, and we foresee the coming quarters also very healthy. With that only our expansion, whatever the cap of capex we are going to be put in, we can able to comfortably manage. And what we are intent to expand further our capacity on the ingot and wafer, that LLM3 also can able to take care.
On that note, Mr. Manjunath, in fact, that was exactly my next question. The wafer and ingot facility that you're talking about, this 9 gigawatt facility, the capex here is expected to be between 5 to 5,500 crore rupees. Talk to us about what the funding plan is over here, and are you looking at any more capex spends in the next couple of financial years? If so, what would the funding mix look like? How much would be internal and how much would be via debt?
So this year, as we already said, 5,500 crores we are spending for the present expansion, and in that we have already spent about 60% of orders has been already given. And yes, then further the ingot and wafer manufacturing also we are expecting between 5,500 to 6,000 crores of capex. Here we see comfortably we are, as of today, if our cash flow see, we are most of the things we are going to be covering the internal accrual. We may definitely opt for some of the debt or some other revenues or the capex rise, which whatever it going to be, we are going to be below 1 in the debt to equity ratios. Less than 1, I can say 0.6 to 0.75.
Could you quantify this debt that you are looking to overtake in terms of your capex spends? Any number if you can help us with?
Which is going to be very less. The first present one, we have taken about 60% of the debt we have taken, 40 has been internal source. In the coming one, it's going to be much better. We may opt definitely below the levels.
Okay. And are you on track for your FY28 annual install capacity target? If I have it right, for modules that's 16.3 gigawatt, for cells that's 8.9 gigawatts. Are we on track for that?
Yeah, definitely. We are in full track, and December we are going to commission the module line, which is going to be take up to the 16.3 gigawatt of capacity, and cell is going to be completed by March, which is going to be take to the 9 gigawatt of capacity. And we are in full track, and the construction as well as the expansion facility and the other things is going in a right manner as of today.
So fully on track to meet your capex guidance then. But sir, I also want to bring up, you have previously spoken about exports being a long-term opportunity for the company. Now, given the current global demand environment and the current macro outlook, how are you now seeing meaningful opportunities in the international markets for your company? And can you also expand on the target mix that you are planning to achieve in terms of international exports?
So that is going to be added advantages. If you see now, the Europe has been coming to the new NZIA law, which is going to be take care of at least 10% to 30% of their installed capacity on the renewable energy, especially on the solar, has to come from other than the China. So which India, especially players like us, where MV has been started selling the modules in 2006 onwards to the 100% my capacity to European countries. So that will definitely going to be boost us furthermore. It is going to be upside, which is the law has been implemented in few of the countries now. Italy has been already done, and France and Paris. These people has already moved in a advanced stage. So that will going to be added advantages. So export always going to be good for the India, but time it will take some time to reach. But this year we see some growth may come into the picture.
Okay, understood. And we'll be watching out for all of these developments in your business. Mr. Manjunath, thank you so much for your time today. Good to be speaking with you.
Thank you very much.
Thank you so much. Viewers, with that, it's time to slip into a very short break. We'll have more management conversations lined up on the other side. Stay tuned and we'll be right back after this quick break. Back with Midcap Masala, you're watching us live from the Suzlon studio here at ET now. Just putting the spotlight on a stock from the broader end of the market that's doing really well for itself, and that's Mrs. Bector's Food. That stock is in focus today after Sunil Singhania's Abacus has picked up a 0.95% stake, so roughly close to 1% stake in the company. Just taking you through what the finer details are, the deal has been priced at 168.97 rupees per share, which is exactly the company's closing price in trade yesterday. And this sums up to about 29.39 lakh shares that Abacus has picked up. Now, in terms of the shareholding, if I have to break it down, promoters hold 49% of Mrs. Bector's, with FIIs holding 10.4%. DIIs here have a very big stake of 25.2%, with the public shareholding at 15.35%. So that's something that we're seeing for Mrs. Bector's. In terms of what the significant DII holding is, Canara Robeco Mutual Fund, Axis Mutual Fund, SBI Multicap, Aditya Birla Sun Life, Invesco India, all of them have a good share over here. And this is the news that we're seeing over here. Some good brokerage action in the month of July, where Investec, Motilal, Anand Rathi and Elara have all maintained their buy rating and their target prices on the stock. So the outlook looks good. And yes, this investor interest from Abacus that we're seeing for Mrs. Bector's has led to a very sharp spike in the stock. While that's on that stock, let's shift focus and connect with the management of CMEC, who've joined us on this the show. Mr. Naveen Mota, the whole-time director and president of operations at CMAC, has joined us on the show. Mr. Mota, hi, morning, and good to be speaking with you. You know, a significant charter coming your way on the Lamprell barge charter. Give us a sense if this is a one-off deployment for CMAC Glorious, or are you seeing this converting into a longer-term relationship with Lamprell beyond this 180-day time period?
Morning. So on this Lamprell charter, we have been discussing with the Lamprell for quite some time, and we hope that this is not going to be one of kind of relationship with them, and we will be having many more of such similar contracts that we will be announcing.
Hi, morning, Mr. Mota. Meryl D'Souza as well joining in on this conversation. Can you just expand on beyond CMEC Anand? Is there any other vessel acquisition or fleet expansion which is under active evaluation for the company for this continuing year, FY27 as well as FY28?
So we keep looking for suitable acquisition, and as we have been seeing that there are sectoral tailwinds are there, and we are continuously in talks with many vessel owners for acquiring some tonnage. So talks are going on with a couple of people, and as soon as something concrete is there, we will be definitely announcing it to the stock exchanges and to people at large.
And Mr. Mota, CMEX Paladin has finally arrived back in India after being stuck in Dubai for quite some time. Can you talk to us about what is the status, and by when can Paladin now be ready for full-time deployment, and any contracts that you are trying to bid for Paladin?
So Paladin has come back from Dubai. It was stranded due to this geopolitical situation. So it has come back to Mumbai. And as we speak, a vessel has been already gone back on its contract with ONGC. So we have already announced this to stock exchange yesterday that vessel has gone on air.
Right, Mr. Mota. On this ONGC tender, can you tell us if there are any other large ONGC tenders which are coming up in the near term where CMEC is actively bidding?
So currently there are no upcoming tender for the ONGC, but majority of our vessels are already contracted for long term, and there are some other tender which are coming, which will be for work in ONGC Mumbai High Field only. So that we will be soon announcing the outcome of those contracts.
Mr. Mota, I'm just trying to understand the UK subsidiary impairment that has taken place. The street is doubtful about the European subsidiary now going ahead and bagging contracts from Norway or the rest of Europe. Can you give us a latest update on what's happening when it comes to your European business?
We have taken a very conscious call on the impairment, because due to this geopolitical reason that there has been some kind of downward revision in the prices over there. So we have taken a very conscious and judicial call on making this impairment. And we still continue to look forward to expanding our geographical reach in North Sea area. But we want to go there with a very cautious kind of approach. We don't want to go just headlong, and because the assets which are required to work there are very less, but it is a quite demanding kind of requirement. So we are still evaluating the option over there, and we'll definitely come back if something concrete is finalized.
Understood, Mr. Mota. Now, I just want to understand about your bidding pipeline. So given the current geopolitical scenario and the geopolitical volatility in West Asia, has your bidding pipeline or client conversations changed materially over the last quarter?
See, currently all our vessels are already deployed either on long-term basis, or we already have some visibility for deploying them. So right now there is no idle capacity, but we are still getting some inquiries which are quite positive, and that's why we are looking for newer acquisition of the vessel, and we are talking to possible sale of possible purchase for some one or more vessels.
Okay. And Mr. Mota, I'm just trying to understand, given that this geopolitical uncertainty is back once again, we've seen a lot of volatility when it comes to trade routes also. Is the guidance that you've given for FY27 still intact, 15% growth in both top and bottom line, and EBITDA margins around 40 to 42%? Just talk to us about whether this growth is on track first.
That growth remain intact, because most of our vessels are either working on Mumbai in coastal area of India, or one of the vessel is working in Saudi Arabia, which remains unaffected. So the only impact we had was when Paladin was stranded over there, but now Paladin is already back into the Mumbai and in the contract. So we do not see any kind of dent in the guidance what we have given.
So that sounds good. Mr. Mota, on that note, you've also guided for your EBITDA margin to be between 40 and 42%. Last quarter, this number was at 49. Before that, it was around 43, 44. What would lead to this sequential moderation that we're expecting to see? And while I understand that this is for the recent quarters, can you give us a sense on by when you see this number crossing 50% perhaps?
If our business get affected due to this seasonal variation, where during the monsoon period some of our vessels are not working, so that's why you will see that numbers during the Q2 are lumpy numbers, and Q4 are the best number. So that's why the margin, if we look at quarterly basis, it will look that okay, we are having Q4 which is a good margin, then Q3, Q1, so it's like that. But overall, we think that we can maintain 40 to 42% comfortably, and maybe with one or two more new contract coming in, maybe we will be able to improve on that also.
Okay, so we're going to be watching out for that, and especially on that margin number. But Mr. Mota, thank you so much for taking the time out and speaking with us. So good to be talking to you today.
Thank you.
Thank you so much. So viewers, that was the management of CMEC joining us on the show. But with that, I'm afraid we're completely timed out on this edition of Midcap Masala. From Meryl, me and the team that put this show together, thank you so much for watching. But keep watching ET Now, because Buy Now, Sell Now is up next.